the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore equities began the day in the red, with the benchmark index retreating further by midday break, driven by losses in banking counters. So as at noontime, the Straits Times Index was down 1.7% at 3,795 points after nearly 420 million securities changed hands in the broader market. Now let's take you through the closing numbers. The STI down 1.58% at the close. We're looking at 3,801 points. In terms of value turnover, that's 1.23 billion Sing dollars. Now gainers trailed losers, 192 versus 346. Top advances for today, we've got here Sim Leisure, BRC Asia and Hotel Properties Limited. And top decliners, let's take a look at them. We've got here DBS, UOB and OCBC Bank, the trio of local banks here. Now, in terms of companies to watch, we do have SETS, given how the firm and its wholly owned subsidiary, Worldwide Flight Services, clinched 14 new cargo and ground handling contracts from Air India. Now, elsewhere from Nvidia slamming new US chip export restrictions that are expected to be announced soon, to how shares of Bloks Group jumped as much as 82% in their Hong Kong trading debut. We've got more international and corporate headlines in focus. And joining me on a Friday is Sunny Soh, Lead Technical Analyst, Capital Markets and Investor Education at SIAS. Sunny, how are you? How's your holiday?
Hi, Tian Tian. Happy New Year. I'm good, and thanks for having me back on the show for the new year.
Oh, it's been such a long time since we last chatted on the air, but let's start with the Singapore stock market as usual, Sunny. How did the STI fare today? Any surprises when it comes down to the companies to watch? The trio of local banks, DBS retreating from that record high of $45 that was registered earlier in the week as well.
Yes, on our STI index, we are down about 61 points today, or 1.58% to close at 3,801 points. This is following a negative trend in the global markets overnight, as investor sentiment was dampened by growing apprehension over the potential impacts of a new tariff under the incoming U.S. administration. And yesterday, we also saw a small drop of 0.63% on the STI index, and this 2 days decline came after the 1.54% jump that we saw on Wednesday that propelled STI to a 17-year high of 3,887 points. But for the trading week, the STI is still down 70.70 or 1.8%, and this is the first negative week in 3. On the big movers on the STI today, we see Yangzijiang Shipbuilding and Sembcorp both lower by more than 3%. There were not many development on news these 2 days regarding this pullback. In fact, Yangzijiang Shipbuilding had their target price raised by CGS International this week to $3.62 from $3.20, as their earnings are likely to benefit from the Chinese yuan depreciation. So I'll attribute this 2 days pullback to profit-taking after the STI hit a 17-year high on Wednesday. And on our three local banks, they are down around 2% today. But for the trading week, they are still positive, with OCBC leading the pack up more than 2.2% for the week. And then you also mentioned DBS hit an all-time high of $45.44 this week on Wednesday.
Yep.
And this was due to the better-than-expected US ISM service PMI data this week that then project or points to likely fewer interest rate cuts this year, meaning that the rates are likely to remain elevated, hence benefit our local banks' net interest margin further.
Okay. Now let's zoom in on some of the other companies to watch. Sunny, we've got here SETS. And SETS, as well as its subsidiary Worldwide Flight Services, they have clinched 40 new cargo and ground handling contracts from Air India. And Air India also renewed 11 existing contracts with them. So how significant is this for SETS where the share price movements are concerned?
I think this is likely a very good news for SETS shareholders, because looking at the share price today, it's largely flat. I believe it closed at around $3.62, so not much movement today. And this is commendable because STI, like we said earlier, is down more than 1% today. So the new cargo and ground handling stations are in North America, UK, Europe and Asia, so globally. And this will significantly expand Air India partnership with SETS and WFS. And looking forward, SET is also likely to post strong earnings for three-quarter FY 2025 after significant core earnings improvement in earlier quarters as well. The in-flight caterer and the ground handler earnings may also be supported by a strong global air cargo volume amid the seasonally strong year-end quarter of October to December. And recently, I also saw reports that UOB Kay Hian also maintains the stock buy rating and target price of $4.30 as they expect SET's 3Q core earnings to be over $90 million without factoring in possible forex translation gains of up to $20 million. DBS, on the other hand, also have a buy rating for SET with a target price of $4.40. So the outlook for SET in the coming quarters does look bright.
Now let's stay in Singapore, Sunny, and take a look at SGX activity in general. If we look at the total securities market turnover value on the SGX, that climbed 5% on the year to 20 billion Sing dollars in December. SGX in its monthly market statistics also said that the STI recorded a 17-year peak during December. It rose 1.3% to 3,787.6 points. How sustainable is that positive momentum, though, if we look at the IPO pipeline and the activity on the SGX?
Yes, I like to point out that the increase in the total securities market turnover value was led by mainly increase in the total trading volume of derivative contracts, which advanced 18% for the year of 2024 to an all-time high of 298 million contracts. So the global events last year, like the US Fed interest rate cut, China policymakers introducing new stimulus measures, led to more investors assessing opportunities across equities, FX, and commodities on the exchange. This is driving the record volume for key derivative contracts. In particular, the equities index futures trading volume, including contracts covering key markets like India, Japan, and Singapore in our region, advancing 4% year-on-year in December to 13 million contracts, and 8% for 2024 to 167 million contracts. The FTSE China A50 index futures was also another bright spot as trading volume climbed 14% year-on-year to 8.5 million contracts in December, translating to a 17% increase of 103 million contracts for 2024. This is the highest we have seen since its launch in September 2006. For commodities traded volume, it also increased 31% in 2024, marking a record annual volume in benchmark iron ore, SGX Cyclone rubber, as well as petrochemicals. So we can see that the increase was attributed more to derivative trading and less of securities trading or the capital markets or the IPO pipeline. So the MAS and SGX Bloks Group discussion is still ongoing. One of the key issues that was identified was the lack of more high-quality companies wanting to IPO or raise capital in the Singapore market due to low valuation and the lack of liquidity. I am positive on the outlook of the STI this year, with the interest rates projected to remain high, benefiting our banks in the first half of this year, which make up of close to 50% of the STI index weight. And even with interest rate cut projected for the second half of 2025, our REITs may also benefit from that, so we may have a chance that the STI may retest the all-time high in 2007 again, where it hits 3,906 points, even though the IPO pipeline might be a question mark.
I suppose lots to watch in the rejuvenation of the SGX. But speaking of IPOs, Sunny, let's head over to Hong Kong because shares of Bloks Group, or the Chinese maker of Ultraman and Transformers figurine. Gosh, I've not seen Ultraman in a long time. But shares of Bloks Group jumped as much as 82% in their Hong Kong trading debut after their $215 million USD IPO drew overwhelming demand from individual investors. We are looking at demand from individual investors being about 6,000 times the number of shares set, boosted by, of course, the abundance of zero-interest loans available for purchase of the stock. Question though then, Sunny, how concerned are you about individuals in particular using margin financing to participate in that IPO?
Firstly, Tian Tian, don't expose my age here. I watched Ultraman when I was a kid. So I do think the explosive debut was really a jaw-dropping, as much as 82% jump in the trading debut. And then this may be one of the reasons why we are not able to attract better quality IPO companies in Singapore. But that could be a good and bad thing because it highlights the risk and rewards of IPO, which particularly fueled by margin financing, right? It's inherently the risk is very high. So while the 82% jump in share price in its Hong Kong debut is a testament to the company's popularity as well as investors' enthusiasm, the use of margin financing, right, does raise some concerns, especially for retail investors. The amplified returns of margin financing allow investors to leverage their capital and potentially increasing their returns. However, this will also magnify potential losses if the IPO is overpriced or the price goes south on the IPO debut. So this amplified return, the easy accessibility of a zero-interest loan, can trigger a FOMO effect, or what we call the fear of missing out mentality, pushing investors to participate regardless of their financial situation or the understanding of the company. And many investors, right, may not fully understand the intricacy of margin financing, including the risk associated with leverage, and this could lead to impulsive decisions and potentially capital losses. The overexposure to take on more debt to participate in an IPO can leave investors highly exposed to market volatility, and a sudden drop in the share price could also result in losses exceeding their initial capital or the capital that they have. So while the potential for high return is very enticing, IPOs are inherently very risky investment as the company's future performance may be uncertain, and using margin financing further amplifies this risk. So investors should always do their due diligence before investing in any IPOs, especially with margin financing, and this includes understanding the company business model, their financial performance, and the competitive landscape. And investors should also assess their own risk tolerance to ensure that they are comfortable with the potential losses of margin financing that can cause them.
If you're just tuning in, we're now in conversation with Sunny Soh, Lead Technical Analyst, Capital Markets and Investor Education at SIAS. But I really want to take a look at this one relating to Nvidia. Nvidia actually criticized new chip exports restrictions that are expected to be announced soon. So Nvidia said the White House was trying to undercut the incoming Trump administration by imposing last-minute rules. How would you read into the latest comments by Nvidia? How much of a dampener would the restrictions be, not only for Nvidia, but also for its other fellow industry peers?
Yes, Nvidia, the darling of last year in the stock market performance, leading the AI rally. I think Nvidia criticism of the new chip export restriction by the Biden administration to a certain extent reveals a complex interplay of geopolitical tension, business interests, and potential economic consequences as well. So Nvidia's statement can be a strategic move to influence the upcoming policy by framing the restriction as a politically motivated, and Nvidia aims to maybe gathering support from industry players to potentially sway the opinion. So Nvidia may also be concerned about the potential impact of this restriction on its business. So as an analyst, I may analyze well the financial numbers of Nvidia and do a good projection, but this factors outside of the company performance, like the geopolitical risk, can become a huge factor to investors investing in Nvidia. And China being a significant market for Nvidia, right? Any limitation on chip export could significantly impact its future revenue and growth prospects, and that may also harm American chip makers' competitiveness in the global market. Although the immediate impact of the restriction may be limited because they already developed some alternative chips for the Chinese market, the long-term implication could be more significant, as this restriction could hinder Nvidia's ability to expand its presence in China, which is a key market for AI development and adoption. And the restriction could also have a ripple effect on other chip makers as well, particularly those with exposure to the Chinese market. And it could lead to increased competition in other markets and potentially slow down the development of AI technologies altogether.
I see. And finally, before we let you go, Sunny, Wall Street closed for a national day of mourning for the late former President Jimmy Carter yesterday. Few catalysts to drive business today, but at the front and center of investors' minds would be the release of the latest U.S. nonfarm payroll numbers. I believe we are looking at a gain of about 155,000, 160,000 versus that 227,000 in November. So what are you expecting on this front?
Yes, all eyes are on the non-farm payroll results tonight. The expectation that you mentioned are in line with mine. And if we do get a strong report, we may find that the market reaction that is not going to be a lot, because we have pulled back quite a bit in the past few days. So maybe we will recover the loss that we saw in the S&P 500 on Wednesday. And this is because having a strong result, right, could be one of the reasons for the Fed not to lower interest rate this year. So good news may not be all good news, and I am expecting a strong number that still reflects a strong U.S. job market, given the surprise jump that we see in the ISM service PMI data this week. So I think investors should look out for this number tonight and see how the market reacts.
And a quick one, any cuts this meeting for the FOMC? No cut for you?
I'm on the side of no cuts.
Okay, all right. Thanks a lot, Sunny. That was Sunny Soh, Lead Technical Analyst, Capital Markets and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.